In the neon-soaked nights of Tokyo in the early 1980s, the world was witnessing a shift in geopolitical power so profound and terrifying that it threatened to upend the established order of the 20th century. Because Japan was not just rising from the ashes of World War II, it was conquering the globe and the island nation that had been reduced to rubble. Just a few decades earlier, had risen like a mechanical phoenix to become an economic leviathan that seemed destined to swallow the United States whole. To the average American worker watching the evening news in 1985, the situation felt less like a trade competition and more like a foreign invasion, not with soldiers or battleships, but with semiconductors and sedans as the streets of Detroit. Once the proud beating heart of global industry, were now filled with efficient, reliable, and affordable cars made by Toyota and Honda, while American factories rusted and closed their doors, leaving thousands of workers unemployed and angry in the Rust Belt. The fear was palpable, and it was everywhere, as Japanese corporations flushed with cash from their massive trade surplus began buying up the most iconic symbols of American heritage, including the Pebble Beach Golf Course, and eventually even Rockefeller Center in New York City, which felt to many like a cultural humiliation, a sign that the American century was ending and the Japanese century was beginning. The statistics were undeniable and terrifying, as Japan was capturing the global market share in almost every sector that mattered, from consumer electronics, where Sony and Panasonic were crushing American rivals, to steel production and shipbuilding, creating a trade imbalance that was bleeding the United States dry and turning the world's largest creditor nation into a debtor for the first time in generations. In the halls of Congress, the mood was turning ugly, with politicians giving furious speeches about the yellow peril and the need to protect American industry from what they called unfair predatory pricing. And the anger boiled over into the streets, where frustrated auto workers and congressmen gathered on the lawn of the Capitol building to publicly smash Toshiba radios and Japanese cars with sledgehammers in a display of raw populist rage that signaled a trade war was imminent. The narrative in Washington was that Japan was cheating by keeping the value of their currency, the yen, artificially low, which made their exports cheap for Americans to buy, while simultaneously making American goods too expensive for Japanese consumers, essentially rigging the game to ensure they won every single hand. President Ronald Reagan, who had campaigned on a platform of restoring American strength, faced immense pressure to act because the free market principles he championed were failing to stop the Japanese juggernaut, and the protectionist cries from the Democrats were getting louder, threatening to pass harsh tariffs that would close off the U.S. market to Japanese goods entirely, which would have been a declaration of economic war that could shatter the Western alliance. But inside the U.S. Treasury Department, a different plan was being hatched by a group of men who believed that they could bring Japan to its knees, not with tariffs or barriers, but with the cold hard mechanics of high finance. And the architect of this strategy was James Baker, the Secretary of the Treasury, a man who understood that the most powerful weapon in the world was not a nuclear missile, but the exchange rate, because he knew that money itself could be weaponized. Baker knew that if he could force Japan to appreciate the yen, if he could make their currency stronger against the dollar, then the price of every Toyota and Walkman sold in America would skyrocket, destroying their competitive advantage overnight. But he also knew that Japan would never agree to this voluntarily, because it would mean strangling their own export-driven economy, which was the engine of their post-war miracle. So the trap was set with the precision of a military operation, and in September of 1985, a secret invitation was sent out to the finance ministers and central bank governors of the world's 5 largest economies, the G5 inviting them to a clandestine meeting at the Plaza Hotel in New York City on a Sunday afternoon to ensure the markets were closed and the press would be caught off guard. The Japanese delegation, led by Finance Minister Noboru Takeshita, boarded a plane to New York, believing they were coming to negotiate a way to avoid tariffs and keep the American market open, But they did not realize they were walking into an ambush, where the terms of their surrender had already been drafted by American officials who were desperate to stop the bleeding of their own industrial base. The atmosphere was tense as the black limousines pulled up to the Plaza Hotel, a symbol of old-world luxury that was about to become the site of a brutal modern execution. And as Takeshita entered the conference room, he faced the united front of the Western powers, including West Germany, France, and the UK, who were all determined to solve their own economic problems by exporting them to Tokyo. The Americans made their position clear, which was that the dollar was too strong and the yen was too weak, and unless Japan agreed to a coordinated intervention to drive up the value of their currency, the Reagan administration would step aside and let Congress pass the protectionist legislation that would ban Japanese goods and destroy their economy, instantly leaving Takeshita with a choice between a slow death by currency appreciation or a sudden death by trade embargo. It was a masterclass in geopolitical arm twisting, and as the meeting stretched on, it became clear that the Japanese delegation was cornered, forced to choose the lesser of two evils in a high-stakes game where the house always wins. The agreement that emerged from that smoke-filled room on September 22, 1985, would become known to history as the Plaza Accord, a document that sounded bureaucratic and benign, but contained within its clauses the code for an economic self-destruct sequence that would haunt Japan for generations and reshape the global economy forever. When the announcement was finally made to the world, the markets reacted with immediate and violent volatility, as traders realized that the world's most powerful central banks were conspiring to drive the dollar down and the yen up, triggering a massive sell-off of American currency that sent the value of the Japanese yen soaring into the stratosphere faster than anyone had predicted, causing immediate panic in Tokyo. In the span of just 2 years, the value of the yen doubled against the dollar, moving from around 240 yen to the dollar to just 120, which was a catastrophe for Japanese manufacturers who saw the cost of their products in America double overnight, effectively wiping out their profit margins and rendering their goods uncompetitive in the market they relied on for survival. The impact on the ground in Japan was visceral and terrifying, as the phenomenon known as indaka, or high yen recession, slammed into the country, causing factories to close and exports to plummet as the industrial machine that had powered the Japanese miracle began to sputter and stall under the weight of a currency that had become too strong too fast. Panic spread through the corporate boardrooms of Tokyo as titans of industry, like Toyota and Sony, realized they could no longer make money by simply exporting cars and electronics to America, forcing them to slash costs and move production overseas to cheaper countries, which hollowed out the domestic manufacturing base and threatened to drive the economy into a deep depression. Desperate to stop the bleeding and prop up the export sector, the Bank of Japan looked for a way to stimulate the domestic economy to compensate for the loss of foreign sales, and under immense political pressure to keep the growth engine running, they made the fatal decision to slash interest rates to historic lows. The logic was that if they made money cheap enough, corporations would borrow to invest in new technologies, and consumers would borrow to spend, thus creating a new internal demand that would replace the lost exports. But in reality, they were pouring high-octane fuel onto a fire that was already smoldering. The flood of cheap money unleashed by the central bank did not go into productive factories or research and development as intended, but instead flowed like a tidal wave into the two most speculative asset classes in existence, which were the stock market and real estate, creating the conditions for a financial bubble of such epic proportions that it would defy the laws of economic gravity. Suddenly, every Japanese salaryman and corporation had access to nearly free money, and with nowhere else to put it, they began to buy land and stocks, driving prices up, which in turn increased the value of their collateral, allowing them to borrow even more money to buy even more land in a self-reinforcing feedback loop of insanity. The government and the Ministry of Finance, blinded by the illusion of prosperity, encouraged this behavior, believing that Japan had finally cracked the code to infinite growth, and that asset prices would rise forever, creating a new era of wealth that would make the previous decades of industrial success look modest by comparison. By 1987, the situation had detached itself from reality, as the price of a simple square meter of land in the Ginza district of Tokyo rose to over $200,000. And golf club memberships were trading for millions of dollars like rare works of art, while corporate profits became secondary to the profits made from financial engineering and speculation. The entire nation was gripped by a collective hallucination of wealth, where hardworking people abandoned the values of thrift and production that had built the country and instead embraced a culture of excess and luxury, wrapped in gold leaf and served with champagne, while the rest of the world looked on in bewilderment. The market capitalization of the Tokyo Stock Exchange surpassed that of the United States, and the land under the Imperial Palace in central Tokyo was valued at more than all the real estate in the entire state of California, combined a statistic that signaled the peak of the madness, but inside the bubble, the music kept playing and the party showed no signs of stopping. The Plaza Accord, which had been designed by the Americans to balance trade, had inadvertently mutated into a monetary monster that was inflating the Japanese economy to the bursting point. And while the U.S. export sector was beginning to recover, thanks to the weaker dollar, Japan was drifting towards a cliff edge with its foot taped to the accelerator. The defining tragedy of this period was that the Japanese leadership believed they were managing a transition to a modern consumer economy, when in fact they were hollowing out their foundation and building a skyscraper on quicksand that was being eroded by the very monetary policy they thought was saving them. As the 1980s drew to a close, the atmosphere in Tokyo was electric with the energy of a supernova just before it collapses, a blinding flash of brilliance that hid the inevitable darkness that was waiting to consume the future. And the end of the decade marked the zenith of the madness, a time when Japanese corporations were flush with so much cash that they began engaging in Zytec, or financial engineering, earning more from trading stocks than from making products. But the forces of gravity could not be ignored forever, and the Bank of Japan, finally realizing that the speculative fire was threatening to burn down the entire house, decided it was time to take away the punch bowl and began to aggressively raise interest rates to cool down the market, which triggered a violent freezing that shattered the brittle structure of the bubble economy, causing the stock market to crash on the first trading day of 1990, plunging downward with a ferocity that wiped out trillions of yen in wealth in a matter of months. As the stock market collapsed, the banks, which held massive amounts of stocks, as capital saw their balance sheets decimated, forcing them to stop lending, which in turn caused the real estate market to implode, as developers and speculators who had borrowed billions against overvalued land suddenly found themselves underwater and unable to refinance. The spiral of destruction was absolute, as the land prices that had been assumed to be invincible fell by 50, then 60, and in some commercial areas, eventually 80%, leaving the banking system choked with bad loans that were essentially worthless zombie assets that would clog the arteries of the economy for decades. This was the beginning of what economists would call the lost decades, a period of stagnation and deflation, where prices fell, wages froze, and the vibrant dynamic economy of Japan turned into a slow-motion train wreck of aging demographics and diminishing returns. The once feared Japan Inc., which had terrified the West just a few years earlier, was now seen as a cautionary tale of hubris and mismanagement, a giant that had tripped over its own feet and fallen into a coma from which it struggled to wake. In the United States, the fear of a Japanese takeover evaporated almost overnight, as the threat of the yen was neutralized, not by the superior quality of American goods, but by the astute and ruthless maneuvering of American financial diplomacy, which had tricked Japan into committing economic suicide. The Plaza Accord effectively solved the American trade deficit problem by forcing Japan to make its goods too expensive and then encouraging it to blow a bubble that destroyed its own financial system, a dual victory that secured American economic hegemony for another generation without a single shot being fired. Today, as new economic powers rise and challenge the dominance of the dollar, the story of the Plaza Accord serves as a dark reminder of the lengths to which the reigning superpower will go to maintain its position and the devastating cost of miscalculating the true nature of the game because the neon lights of Tokyo still shine, but the shadow of 1985 stretches long across the pavement, a testament to the time when Japan bought the world only to find that the price was its own soul.